AM Best has maintained a stable outlook for South Korea's non-life insurance segment. Here to discuss the outlook is Associate Director of Analytics, ChanYoung Lee. And ChanYoung, what are the key drivers for the stable outlook?
Yes, thanks, John. So we're maintaining the stable outlook given the favorable underwriting performance, mainly driven by the good results in the auto insurance line and also steady investment performance. Last year, the industry's total net profits rose by 72% to a record high of 3.7 trillion Korean won, which is roughly equivalent to $3 billion US. This was primarily due to a material improvement in performance of auto insurance line, which historically has been a loss-making business. The combined ratio of auto insurance line improved from 111% in 2019 to 102% in 2020, and it went down further to 97% in 2021. About this improvement, there are two major factors that came into play. First is a drop in claims frequency due to low traffic volume during the pandemic, and second is increased premium base following a series of rate hikes in the prior 2 years. We also note that the distribution cost efficiency in auto line has been improving because of the fast-growing share of online sales, which was further accelerated by the pandemic in recent years. Another driver for the stable outlook is steady investment performance, which is a key source of earnings for the industry. Net investment yield slightly declined, but overall investment earnings increased by 4% in 2021, thanks to a continuously expanding asset base. Insurance have been trying to grow alternative investments, such as real estate or infrastructure-related funds, corporate loans, and private equity funds. And relatively higher returns from these assets also supported the investment profits for insurers. Another thing we are closely watching is the rise of market interest rates. Interest rates have been rising rapidly since the second half of 2020. The 10-year government bond yield has increased by 170 basis points over the past 18 months. It is unlikely that insurers will benefit notably from the recent rise for some time, because of the small size of new investments relative to total investment assets. But we expect that this trend will help slow down the ongoing decline in investment yields over the coming year.
Despite the improved profitability of non-life insurers, were there any obstacles along the way?
The industry is still under pressure because medical claims remain elevated in the long-term insurance line, which is the largest business segment for the industry. An increase in moral hazard and overtreatment by clinics and hospitals was the main driver of this pressure. Insurers were able to increase premium rates for medical indemnity coverage in recent years, which is basically a private insurance cover that supplements national health insurance. But these annual rate hikes were considered not enough to reflect the recent surge in claims because there is implicit pricing control by the regulator on this coverage, in addition to a 25% regulatory cap on annual rate increments. But over the coming years, we expect that the cumulative effect of the recent rate adjustments will become much more noticeable. The renewal period of legacy medical indemnity policies are generally 3 or 5 years. So as more policies are renewed down the road, we will be able to see the impacts being materialized. Apart from the underwriting side, another issue that we have been observing in more recent periods is the pressure on insurer solvency position amid rising interest rates, as the size of unrealized gains from available for sale financial securities has declined. The capital pressure is more pronounced under the current solvency regime, where assets are viewed on market value while liabilities are booked on a cost basis. But we expect that this issue can be largely mitigated, especially for companies with effective ALM capabilities, once the new solvency scheme is adopted next year, where both assets and liabilities will be viewed on market value. But of course, we will continue to keep a close watch on the market rate trend and their impact on the insurer's balance sheet.
Looking ahead, ChanYoung, what's the expectation of underwriting performance?
We expect that the overall underwriting performance will remain stable over the next 12 months. The favorable impact of COVID-19 on auto insurance will fade gradually as the industry already started to see a rebound in auto claims after the government lifted most of its COVID-19 restrictions in April this year. But we believe that the industry will be able to manage its auto profitability effectively, supported by larger premium base as well as improving cost efficiency. We also note that there are a number of new regulations that have been in the process of being implemented since last year that can partially mitigate the potential rebound in claims. These regulations include reduced speed limit in urban areas and a substantial increase in deductibles for DUI-related claims. In the long-term insurance line, we expect that the deteriorating trend of the loss ratio will gradually stabilize due to cumulative effect of rate hikes for the medical indemnity coverage, which I have touched upon earlier. Additionally, there are various mitigation efforts such as tightened claims management and collaborative efforts between the industry and the regulator with regard to moral hazard and overtreatment. Also, a re-engineered medical indemnity coverage was adopted by the government in July 2021, and all of these can help the industry better manage the profitability of the long-term insurance line going forward.
Are there any additional factors that could impact the industry, ChanYoung?
Additional factors that could impact the industry's operating environment include the market entry of new digital insurers and also the new government, which took office very recently, their insurance-related policies, which are not very clear at the moment. We think the impact of these factors will not be material over the short term, but we will continue to monitor any changes in market dynamics and regulations to assess the impact on the industry and existing market players.
ChanYoung, thanks for speaking with us today.
Thank you for having me.
That was ChanYoung Lee, Associate Director of Analytics. You can find the full report online at ambest.com. For AM Best TV, I'm John Weber.